In the previous video, we told the story of how stock ownership began. Ships, trade, shared risk, early shareholders. But today, buying a stock feels almost effortless. You open an app, you type a company name, you press buy. A confirmation appears. It feels instant. But behind that simple tap is a complex system working quietly in the background. So what actually happens when you buy a stock today? Let's walk through it step by step. Everything begins with an order. You decide to buy shares of a company. You choose how many shares. You choose how you want to buy them. There are two common types of orders. A market order means you want to buy immediately at the best available price. A limit order means you are willing to buy only at a specific price. Once you press confirm, your broker receives that order. This is where the invisible process begins. Wondering, who is a broker? Your broker is the bridge between you and the stock market. In the past, brokers were individuals on trading floors shouting orders. Today, most brokers are digital platforms. When you submit your order, your broker does not hold the shares personally. Instead, it routes your order to a marketplace where buyers and sellers meet. These marketplaces are called exchanges. Stock exchanges are organized platforms that match buyers and sellers. Examples include the New York Stock Exchange, NASDAQ, London Stock Exchange. When your order reaches the exchange, it enters an order book. An order book is simply a list of buyers and sellers and the prices they are willing to trade at. If someone is willing to sell at the price you are willing to pay, the trade happens. This matching often occurs in milliseconds. At that moment, you have agreed to buy shares from someone who agreed to sell them. But ownership is not fully settled yet. It's important to understand the difference between the trade execution and settlement at this point. When your order is matched, that is called execution. Execution means a buyer and seller agreed on a price. But ownership does not transfer instantly. There is a process called settlement. Settlement is the process of transferring money from buyer to seller, transferring shares from seller to buyer. In most major markets, settlement happens on what is called T+2. That means 2 business days after the trade. This system reduces risk and ensures both sides fulfill their obligations. So who holds the shares? Here is something that surprises many beginners. When you buy a stock, your name is usually not listed directly on the company's shareholder register. Instead, shares are typically held in what is called street name. This means your broker holds the shares on your behalf. Behind the scenes, a central securities depository tracks ownership. In the United States, this role is performed by the Depository Trust and Clearing Corporation. This system allows shares to be transferred electronically instead of physically. You still legally own the shares. Your broker simply acts as a custodian. What do you actually own? When the settlement completes, you become a shareholder. That ownership typically gives you the right to receive dividends if declared, the right to vote on certain corporate matters. Your ownership percentage depends on how many shares you own, relative to total shares outstanding. If a company has 1 million shares and you own 100, you own 0.01% of the company. That percentage represents your slice of ownership. Why the price keeps moving? After you buy, the price does not freeze. It continues moving. That is because the stock market is continuous. New buyers and sellers enter constantly. Their expectations change. Your ownership stake remains the same number of shares, but the value of those shares changes based on market consensus. Ownership is stable. Price is dynamic. What are dividends? Some companies distribute part of their profits to shareholders. These payments are called dividends. If the company declares a dividend and you own shares before a specific date called the ex-dividend date, you are entitled to receive that payment. Dividends are typically paid in cash. They represent a direct return on ownership. Not all companies pay dividends. Some reinvest profits into growth instead. Both approaches are valid business strategies. As a shareholder, you may have voting rights. These votes typically relate to electing board members, approving major corporate changes. Most retail investors do not actively participate in voting, but the right exists. Ownership includes governance rights, even if you never exercise them. What happens if the company fails? Ownership includes risk. If a company performs poorly, its stock price may fall. If it goes bankrupt, shareholders are last in line to receive remaining assets. Creditors are paid first, bondholders next. Shareholders receive whatever is left, which is often nothing. This is why stocks carry higher risk than debt, but they also offer higher potential reward. Ownership means sharing both upside and downside. So what happens if the company thrives? If the company grows profits steadily, expands successfully, and increases in value, shareholders benefit. Stock prices often rise over time when earnings grow. Your ownership stake may become more valuable. In some cases, companies split their stock. A stock split increases the number of shares while reducing the price per share. This does not change your percentage ownership. It simply changes how it is divided. What do you not own? Buying a stock does not give you control over daily operations. You cannot walk into the company and make decisions. Ownership in public markets is distributed among many shareholders. Management runs the company. The board oversees management. Shareholders influence indirectly through voting and market signals. When you buy a stock, nothing forces you to sell quickly. You can hold for minutes, months, or decades. Historically, long-term ownership has been associated with benefiting from business growth. Short-term trading focuses more on price movement than ownership value. Understanding this distinction changes how you interpret your purchase. Are you buying ownership, or are you trading price movement? The system allows both, but the outcomes can differ significantly. Let's bring it all together. So what happens when you buy a stock today? You place an order through a broker. Your order is routed to an exchange. A buyer and seller agree on price. The trade executes. Settlement transfers money and shares. Your broker holds shares in custody on your behalf. You become a shareholder with legal ownership rights. From that point forward, your experience depends on the company's performance, market expectations, economic conditions, and how long you choose to remain an owner. The mechanics are complex. The idea is simple. You are buying a small piece of a business. The technology changed. The ownership principle did not. In the next video, we will explore why stock prices move up and down and how expectations shape value. Because once you understand what ownership means, the next step is understanding how that ownership is priced.